Another 0.25%, Aussie rates just continue marching higher. Hi, everyone, and welcome to another episode of Insights, brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Branko, who has been all over yesterday's probably mostly anticipated, but nevertheless painful for many Australians, rate rise. How are you going today, Branko?
Good, Chris. Thanks for having me back on.
So, reading your piece today, not really a massive shock, really, that it was raised by another 0.25%. I know that was pretty much what was expected, but can you sort of start us off today? Is that how you took it, that it was actually what was expected? And what was different about this rate rise, in your opinion, over the rate rises that we've been having over so many months before this one?
Yeah, so the market did kind of react in a way that would display that it was kind of in anticipation of this. So,
Mhm.
in short, yes, the 0.25% increase was in line with expectations. However, the difference between this 0.25% increase and all the ones prior has been the language now that the RBA is taking on. That's kind of a very big difference. And what we're seeing now is a lot less hawkish language. And I'll put an example up on screen of them talking about how they expect inflation to start going down, and they kind of understand the pain that their rate rises have caused, and the economy is looking like it's going to slow down. So even though we still have the same rate rise, given the language change, it's looking a lot less hawkish now for sure.
So that's really interesting because they've been going out of their way really to make it crystal clear that they were in this for the long run and that they would do whatever it takes. That's sort of been the general feel up until now. So this is quite a significant change, isn't it?
Yeah, absolutely. And the market reacted, which we'll get into shortly, to that positive part of it. But yeah, it is very different than what we've seen the past, year and a half.
Yep, right. So how did the share market react to that?
Yeah, I mean, so we saw them have a big jump when the statements started coming out and
Mhm.
people started kind of seeing what was going on. Stocks like Maya, which are generally very rate sensitive because they're
Yep.
involved in retail. So obviously, the more discretionary income, that disposable income that individuals have, they're going to more likely spend it on stuff like Maya. So they went up 9%, and the share market as a whole was up, percent or so, 0.5%. So yeah, I mean, the market is very happy with it, and um, yeah, it looks like it's going to be a big change moving forward.
And I did notice a little bit that the Aussie dollar it fell. It didn't. I wouldn't say it was plummeting, and this is something that Alex has been talking about as well. Um, I suppose that puts us further behind the rest of the world if the anticipation is that we're heading into pause a little bit, and the rest of the
Mm.
world is probably still marching ahead at a faster rate.
Yeah, it's a good point. Yeah, we are. Yeah,
And I suppose that would impact the share market as well because it makes the share market probably priced a little bit more attractively.
yeah.
Yeah, right. So, can we look at it a little bit more broadly? I know this is something you've been very interested in and looking at for quite a while now. How do these rate rises impact Australians? We've talked about it before, and I know you've sort of dug a little bit deeper into it. So, can you give us a bit of an overview of what's really going on there and
Yeah,
how the average Australian has been impacted?
yeah. I mean, it's something I just wanted to quickly touch on today. Was like, we hear about rate rises and it affecting people, but what is the true damage, right? So if you took out a $500,000 loan, which is realistically actually lower than the average loan for
Well,
any
yeah, and I mean
Australian.
you're back down in Melbourne now. I know the average prices down there are just extraordinary, aren't they?
Oh yeah, it's absolutely absurd, and we're having, as we discussed last week, a massive kind of rental crisis, in part
Yeah.
because of some of the housing issues. But yeah, so $500,000 loan, if you got that in April 2021, you're paying now over $1,000 more a month just
Mm.
in interest payments. So I mean, that is a very significant difference, if given what the average wage in Australia would be. So, and that's just one example. Obviously, the higher the loan, the more you'll pay. Um, and I mean, it's been quite bad, and wages, as we've kind of discussed in the past, the cost of living crisis, wages have not caught up to these increases,
Yeah.
and Australians are struggling because of that. Wages have stagnated. You have inflation, and on top of inflation, you also have $250 a week basically that you would have vanished. So it's been quite hard for the majority of homeowners.
And you make that point too, that $500,000 is not the average house price in Australia. So
the average is 900, about
yeah,
900,000.
right. So you're talking
But
double that, almost
yeah,
double those figures.
so that could be between a couple as well. That figure,
Yeah,
I'll
true.
put that up here. But yeah, so again, that's basically double what so quite
And
a short difference.
where is that extra income coming from? Which is why I suppose that language has changed. So, can you maybe talk us a little bit more through that idea of the change in language? Is it really? Are they really trying to instill hope here?
Yeah, so I'll kind of put up some of the statements here. What was said, but basically it was around, like basically they acknowledge inflation and how it's expected to slow down. So that's kind of key point number one.
Mm-hmm.
And they acknowledge the kind of damage that these rate rises are doing on people, and that the economy is going to slow down. And then they expect kind of all these things to happen over the next coming months. So, given the RBA's new expectations and kind of new change, obviously it's expected that it's going to be better over the next few after the next kind of few months of short-term pain. Things are going to start clearing up, and you probably won't see these continued rises that we've seen the past year and a half.
And that is really interesting because against the background of what we're seeing come out of the US in particular, and this is something that Alex has been pointing out when she's been discussing it, a lot of your rates in the US for your housing costs are locked in. It's that fixed rate scenario where it was 90 something percent of mortgages were fixed rates. So they really don't have that exposure that we have here because obviously most of our rates are variable, and every small little rate rise has that impact that you just spoke about. So I really wonder if that is being very optimistic by the RBA to sort of come out and really say, okay, we're looking good here, we're looking good for the future. Do you think we don't have a choice in some ways because we may just have to follow what the US does? And they're not saying that. They're still very much jawboning and saying, higher for longer, all that sort of stuff. So if we've got this change in rhetoric here, how do you reconcile that?
Absolutely, that's a great way to put it. I think that the RBA is just going to be forced to stop these rate cuts because at the end of the day, right, our household to debt ratio is like the highest in the world, over 180%. And so these rate rises obviously have a much bigger marginal impact on Australians than they would Americans because of that.
Yep.
So Australians don't have the kind of leeway for this to keep going on, as Americans will be locked into a fixed rate, would obviously be able to endure. So they're probably just changing the language as a way of kind of preempting the future rate cuts as a direct consequence of the Australian economy. And I think that we're going to continue to see a kind of separation of where maybe the rest of the West goes and America goes, and where Australia goes down.
And the argument that, like, sort of the follow-on argument that Alex has been making is it hits the dollar, right? That ultimately something's got to give in that scenario, and it may be that we don't have a choice because it then makes our currency uncompetitive. But I think you've highlighted the point really well. We just simply don't have a choice when the debt is that high. Yeah. You're just going to it hurts people a lot more here than it does in other places.
I mean, like I said earlier, like on a $500,000 loan, over $1,000 a month. That's a lot of money if your wage hasn't really increased, right? So I don't know how they're going to be continue. What, 2,000, 3,000? I mean, at what point are people just going to start defaulting on their home loans? It's we don't have the leeway.
Yeah, and they will know that, and obviously that doesn't help anybody to have situations where people are defaulting on debt, because that is where you get that spiraling negative situation. It's far worse than sort of a general recession across the economy where you've got people actually defaulting on home loans, because that's a large percentage of the population.
Yeah, and I think ironically Australians have been very lucky the past kind of recent history with the lack of financial crises, right? Like we were saved in 2008. We didn't really have many problems here. And as kind of a big irony, we're now probably the ones most vulnerable well, not like in the developed world, we'll be one of the most vulnerable nations because of our household debt in particular.
So the things that helped us in the past are now coming back to bite us in a way.
Yeah.
Like the variable rates, because they did help us. Let's be honest, they helped us when we had rates falling and the rest of the world was stuck on high fixed rates. That was a benefit to us.
Yeah. Yep, that's a good point. It helped people kind of get into the property market and buy property back then, and allowed them to kind of lever up and endure the gains. But now, as we're seeing, we're kind of paying the price for those benefits.
It's going to be very interesting to watch going forward. Branko, thank you so much for your timely analysis of this situation. Like, it really is beneficial and important to look at what's going on, because as you've pointed out today, it's going to be month by month that we need to watch this. And if it's looking like it's changing, it's going to be some interesting months ahead. So thank you very much for that.
Absolutely. Thanks, Chris.
And thanks to everyone for watching. Remember, reach out with any questions or comments. If you agree or disagree, we can certainly discuss all of that. We'll get back to you as soon as we can and discuss it on the show wherever possible. So that's all from us today. Good luck in the markets as they continue to process this rates news, and stay safe out there, everyone.